This video deals with going concern, but Section 18A of the VAT Act that deals with going concerns. So there's an example here on this page, but what's going to happen is I'm going to just try show you logically why Section 18A of the Act is placed in the Act. And it is one of the few times where a buyer would levy output VAT when they buy something. Because normally it's the seller that levies output VAT, but in this section, the buyer is going to levy output VAT. So please pay careful attention so that you understand logically why this happens. So let's just have a look at stuff. So first and foremost, guys, what's going to end up happening? We're going to use that same transaction. What is that transaction? Where we have a buyer that sells something for 500,000 plus VAT. So in this case, normally it would be 75,000 Rand VAT at 75%, and the sale would be levied at 575. So let's just actually have a look what would happen if we didn't zero rate. And let's just imagine this is the SARS bank account. So the buyer would pay, sorry, the seller would pay across 75,000 Rand to SARS, and SARS would debit their bank account. And the buyer would ask for the 75,000 Rands VAT back, and SARS would be in a net null position, and what would happen? That is why we can zero rate going concern transactions, because everybody ends up in a net zero position. But I want to change something now. I want to make the buyer only 60% VATable. Okay. So what would happen is you would still bill out 75%, 75,000 Rand when you sell it. So SARS would still get 75,000 Rand in. But because the buyer is only a 60% VAT vendor, they would only be able to claim 45,000 Rands worth of VAT. And instead of SARS being in a net null position, SARS would actually have 30,000 Rand in the bank. Okay. What would the situation be for the seller? He would get 575,000 Rand, and he would pay the 75,000 Rand, this one, across to SARS. And what would happen from the buyer's perspective? With the buyer would pay 575,000 Rand. They would claim input VAT of 45, and the net cost to the buyer would be 530,000. There's the 45 over there. Now, if you zero rate, what's going to happen, guys? If you zero rate, the sale is going to be at 500,000 Rand because we zero rate for VAT. VAT would be 0 there. Okay? So the net amount for the seller would be 500,000 Rand. And the net amount for the buyer would be 500,000 that he pays across to the seller. But SARS has lost 30,000 Rand. SARS has lost 30,000 Rand. So what does SARS do? SARS says we're going to process what we call a Section 18A adjustment. And what does that mean? The buyer will pay output VAT. And the way that it works is it's the selling price x VAT times by the percentage that cannot be claimed times 15%. So in this example, what is the selling price? The selling price is 500,000. How much cannot be claimed? The buyer's only 60% VATable. So what can't be claimed? 40% times 15%. And when we do that full calculation itself, what do we get? we get 500,000 Rand times by 0.4 times by 0.15, 15%, and we end up with a 30,000 output adjustment. And who's going to pay it? The buyer will pay output VAT of 30,000 Rand. And what's going to happen, guys? When we didn't zero rate, the buyer would have 530 paid out. The buyer's now going to pay outputs of 30,000 Rand. And we end up being in the same position as before. So what you need to understand is whenever you zero rate a going concern, if the buyer is not fully registered for VAT, the buyer will have to do an output adjustment based on the selling price x VAT times per percentage that cannot be claimed times by 15%. So what I think you should do now is you should pause this video and just make sure you read through that set of notes now to make sure you understand it. Okay, so pause the video so you can see the screen or use your notes. But then what's going to happen is I'm going to carry on with the discussion. So I'm assuming that you guys have now read through that. Let's just do a couple of examples. So it says both parties are 100% VAT vendors. A machine that cost 460 is now sold for $1 million. So how much VAT is charged by the seller? 0. How much VAT input for the seller? 0. How much VAT is claimed by the buyer? 0. How much is the 18A adjustment? 0. Why? Because both are 100% vendors and there's no Section 18A adjustment because both of them are vendors. Okay, so that is the way that it works out, and that's what's happening with you zero rating. The seller zero rates, the buyer can't claim anything because there's no VAT. Because the buyer's 100% registered for VAT, no adjustment. Let's now do 100% vendor sold to a 70% vendor. So again, exact same example. Machine that cost 460 sold for 1 million. So the VAT charged by the seller, nothing, because you've zero rated it. The VAT input claimed by the seller, nothing, because you've zero rated it. The VAT claimed by the buyer, 0, because you've zero rated it. But what does Section 18A do? It says, whatever the selling price is, which is $1 million, for the percentage that you were not registered for VAT, the 30%, because if you're a 70% vendor, 30% is non-VATable. So 30% times by 1 million times 15%, 22,500 is going to be a VAT output paid by the buyer to SARS on this transaction. Now, if it says 80% vendor to a 30% vendor, I want to just compare the stuff with you now. So, what's going to happen, guys? VAT charged, same. VAT claimed, same. Okay? Adjustment, okay? What's going to happen? It's a 30% vendor, guys. So look what happens. 70% non-VAT times 1 million times 15% gives you 105k. So guys, it's a 30% vendor, so what happens? 70% adjustment that gets processed. The only difference is when you've got a vendor that's 80%, what happens is they claimed 80% initially. So when it gets sold, if you know your apportionment section, the 20% VAT you didn't claim, you get to claim once you sell it. So that is why you're claiming 20% times the lower of cost or open market value, 460, times by 15 over 115, and you would be able to claim the remaining 12k. Okay, so just want to remind you about that section, because that's got nothing to do with Section 18A. But remember, if You didn't claim all the VAT when you bought it. You can claim the remaining VAT when you sell it. So there it is. So section 18A, guys, what's the rule? Seller charges VAT at 0. Buyer accounts for VAT on 100% minus the actual taxable use times 15% times selling price. So whatever you couldn't claim for VAT, you need to give to SARS as a section 18A adjustment. So let's practice this a little bit. Let's see what this question says. This question says, A Limited sells a business to B Limited, both are VAT vendors. The business is sold for $1 million ex VAT. It says calculate the amount of VAT that is accounted for by the buyer and the seller for each of the following situations. Okay, and it says answer in the following table. Okay, so what does the table say? Type of VAT, okay, output, seller amount, buyer type of VAT, buyer amount in a discussion. So let's start. If the sale was not zero rated for as a going concern. So what happens if it's not zero rated as a going concern? It's sold for $1 million ex VAT. If it's not zero rated as a going concern, what's going to happen? The seller will account for output of 150. Why 150? Because $1 million rand times 15% gives you 150,000 rands worth of VAT. The buyer will claim inputs of 150,000, and that's VAT charged at a standard rate. So if you don't zero rate, you pay VAT normally. If the sale is zero rated and both of them are 100% VAT vendors, think about what's going to happen. Necessary, press pause. Okay, so they're both 100% VAT vendors. So what's going to happen, guys? Output will be 0, input would be 0. Why? Because the transaction is zero rated. Okay. 3. The seller only claims 60% VAT on the business on a cost of 600,000 ex VAT. The buyer was going to use the business 100% for VATable purposes. So, guys, the seller had 60%, the buyer had 100. So what's going to happen? We're going to zero rate the transaction, and the buyer is also going to zero rate the transaction, 0. There is no section 18A adjustment here. Why is there no section 18A adjustment? Because it's only if the buyer is not 100% that there's an 18A adjustment. If the seller only claims 60%, remember what they're allowed to do on sale? They can claim the remaining VAT on sale, 40% that they didn't claim before. Okay, it was 600 ex VAT. Okay, so times 684,000 times 15 over 115, input claimed by the seller, and the remaining amount that has not yet been claimed. So that is what you can claim. Next, guys. It says the sale was zero rated. The seller was 100% VATable, but the buyer was only going to use it 30% for VAT. So guys, the seller's 100%. So what's going to happen? Output VAT is 0. Okay. What's going to happen for the buyer? The buyer is only 30% VAT. So the 70% that is not VAT. Section 18A says you've got to give it back to SARS. So look what happens, 70% times 15% times the $1 million selling price. Remember, it was a $1 million selling price, the business being sold for. And what's physically going to happen? That amount of output needs to be given back to SARS. Last one. The sale was zero rated. The seller claimed 60% VAT on the business cost of $690, including VAT. The buyer was going to use the business 30% for VATable purposes. What is going to happen with this? Guys, output 0 for the seller. For the buyer, 105,000 Rand output. Why? Because it's 70% is not subject to VAT. Business only use of 30%. Because the seller only claims 60% of the VAT on a cost of 690 including VAT, what's going to end up happening here, guys? 40% times 690 times 15/115, input can be claimed, because whatever you didn't claim when you bought it, you get to claim when you sell it. Okay, and I think you guys should understand how this works. As I've said, this is a common exam question, so I think you should learn how to do it. More often asked at postgrad level than at undergrad, but it's important that you need to know how a buyer, when zero rating for going concern, has to account for output VAT when the VATable suppliers that they're going to use the business for are less than 100%.